Hello friends, I am Ankit Kanodia from SmartSync Services, a SEBI registered investment advisory firm. Welcome to the 14th episode of Mission Smile guest webinars, a Mission Smile initiative where we invite smart investors every month and learn from their unique investing style. For those who are joining for the first time, Mission Smile stands for making new stock market investors learn it through engaging research. Before we begin, I would request everyone to please keep yourself on mute and switch off the video so that we can have a seamless discussion and soak in all the knowledge. You may type in your questions on the chat box. We'll take that up in the end. So let's begin. Today, our guest is Mr. Tahir Hussain. Tahir is a senior analytics manager at Visa, and the founder of Invest Karo India, one of the fastest growing Substack newsletters in India. With years of experience working in top firms like Goldman Sachs and Deloitte, Tariq is an expert in finance and investment. Despite having a day job for a long time, Tahir has developed a deep interest and expertise in finding hidden gems in the small cap space of the stock market. He openly shares his investment views and opinions about the business he tracks and holds on Twitter and has close to 1 lakh followers now. I know him and have been following him for a couple of years now and hence requested him for this session today. And I'm so happy that Tahir accepted this. And today he is going to present on special situation investing. So Tahir, welcome to Mission Smile, and now it's all over to you. I'll keep myself on mute and my videos will be off, but I'll be there all the time. If you face any issues, you can let me know.
Sure.
Over to you.
Thank you, Ankit bhai. Yeah, so today's topic is special situation investing, and thank you for a generous introduction. I'm not that kind of like smart or have done anything great. Like I just have been following this style of investing for a couple of years, and I believe there's a lot of myths around it. There's a lot of misunderstanding as well. There's a lot of multiple ways of doing it as well. So I felt that there's a need for a topic around it and kind of a deep dive in it. So throughout the presentation, I'll kind of tell you everything about special situation investing. I've kept it very conversational, so feel free to kind of ask me a lot of questions. And with that, we'll get started. So just a disclaimer, anything that I discuss is not investment advice. I'm not a SEBI registered advisor. I may hold interest in the stocks being discussed here and may choose to buy or sell them in future without any notice. So please consult with your financial advisor before you act on any information being discussed here. So let's start at a very high level as to what's the main crux of investing around. So the based on my definition and based on a lot of other definitions, if I have to boil it down in a very single sentence, it's an exercise in generating risk adjusted return. Now this risk adjusted return part is very important. The lot of people don't understand, and this is the area where like for example, you can put all your money into a single day option expiry and get and that will be like a chance of luck. You can get probably 10x of your money in that day, or you can lose all of it. That's a very high risk, and generating return on that is not really kind of a risk adjusted return measure of it. The idea of investing is to kind of generate maximum amount of return with the minimum amount of risk possible, and the only way to generate minimum amount of risk possible is through margin of safety, or buying something in a very simple terms. If something costs $100, you're buying it for less than 50 rupees. And a lot of names are there around this risk adjusted return. Some people call it margin of safety, some call it alpha, some call it low drawdown strategies, low beta, and whatnot. At the end of it, the crux of all of it is to generate the high risk adjusted returns, generating maximum amount of returns with the least amount of risk possible. And the reason I'm telling you all of this, starting with all of this, because special situations by their inherent nature, are designed to give you a higher risk with least amount, higher returns with least amount of risk possible. So this is like a Wikipedia definition. I've just copied it, and I wanted to kind of draw a parallel between what the traditional finance describes special situation as, and I'll just read it aloud. So it's a typical event which has a high potential to alter the further course of a business, materially impacting the company's value. It may be a positive or a negative event, and then it gives you a bunch of examples of it. The key words here is that it's special situations are events. They're corporate events. They can be internal event or an external event. So example of an internal event would be a reorganization, a change of a management, a demerger or a merger. An external event would be a regulatory intervention or something changing in the landscape of an industry that kind of impacts a company well. And I'll give you examples of all of these. So this event has a potential to impact the future course of the business. It changes things as to how they were, has a material is of material impact, and can be a positive or negative event. So you can play special situations on negative basis as well as positive basis. Each of them have its own connotations there. Um, I have simplified my version of the definition is very simplified. So it's a corporate or external event that allows you to buy a security, or a stock or whatever it is, at one or two sigma deviations away from its fair value. So if you know about normal distributions, let's say a fair value of a stock is $100, you're able to buy it at a very high margin of safety. And that's basically what I'm looking for special situation. I don't care about whether something changes in an industry and everybody on the street knows about it and nothing is still not available at cheap price. That's not a special situation in my book. And that's where there's a key difference in definition. Um, so you have to look on the basis of that. And it's an opportunity to buy and build a large position at a high margin of safety with the least amount of risk available. So in my view, a special situation, if I have to simplify down further, it's any event that allows you to buy something at less than half the price of what it should be valued at. And that's the special situation for me. And unless I can build and buy a large position in it, I'm not really interested in it. So I don't and write issues and things like that where you get like 10-20% kind of return. That's not really a special situation or kind of even uh, important to worth your time, in fact. So couple of myths around it. All spin-offs is special situation. That doesn't, it's not true. The reason why is not true because each special situation is a different. You have to evaluate it as a different company. So somebody is requesting annotation. I'll just say approve. Okay. Yeah. So each special situation is different. You have to evaluate everything at a on its own, how you will evaluate a separate company. Just because a company is undergoing a demerger or it spins off or a change in management is there, or whatever the case is, it doesn't become a special situation. So the reason I emphasize it on enough because in the last 2-3 years, this name has become a buzzword, and in my opinion, there's a lot of not true things around it, a lot of made up stuff around it, whether it's a fund promoting itself or people just kind of just piling onto it. So a lot of myths and things around it. So anything that goes under a spin-off, please don't think of it as a special situation. And especially if everybody on the street knows about it, it's not a special situation. If everybody is aware of something, there's not really everything's pretty much into the price at that point of time. The second part is management change. So management change on its own is not a special situation. Management changes takes time, and if a CEO is being changed, it's not necessary that that's that allows you to buy a company at a cheaper price. So you have to consider this part here based on whether the company is available at a discount to its fair value, or whether that management change is going to change things dramatically in the company in that specified period of time that you choose to be invested at. And again, I emphasize here because this has been promoted as special situation when it's clearly not. A good example here would be Eureka Forbes, where the CEO of Jubilant FoodWorks kind of went to Eureka Forbes. There was stock uh, volatility there. And again, this because the CEO was joining, it was supposed to be a big deal. But after a point, those things stabilize. You wouldn't really hear a lot of people talking about Eureka Forbes because the price action has not been doing well. So uh, again, like just because a very good CEO joins in doesn't necessarily mean that that is becomes a special situation. Um, and then again, this forced selling buzzword. So everybody assumes special situation means forced selling. That's not true. Forced selling happens only, and forced selling is only again um, uh, possible and kind of will lead you for a let's say uh, uh, buying something at less than fair value if the float is less. And by float, I mean how many. So I'll just write float here. Um, so by float, I mean how many stocks are available uh, apart from what the promoter holds. So if a float, for example, let's say is 1 crore and the promoter holds 75% of it. So you have 25% available in the market. And let's say there's one or two LIC or things, people like that that are holding it. And there are mutual funds and stuff that hold rest of it. So that selling by mutual funds, if they are required to do so because of law or regulations or whatnot, then it becomes a special situation because at that point of time, there's already low float available. If something spins off, which is when they will kind of spin it off and the market will value it. So 9 out of 10 cases, market doesn't value it properly. And then on top of that improper valuation, if you have forced selling, in that scenario with a low float, then it becomes something. And then if the company is interesting and its fundamentals are intact, and if you can buy it at less than let's say uh, 4 or 5 cents on 4 or 50 cents on a dollar, then you can kind of term it as a special situation. The one of the examples I would like to give it is here is Piramal Pharma. So Piramal Pharma has almost 100 crores of shares, and float is huge. So it didn't matter there, and everybody on the street pretty much knew about it. There were publications, media chatter, some hour-long segments being done on business channels around Piramal Pharma and CDMO and whatnot. Um, but that's not going to make you a special situation if everybody knows about it and there's enough shares to go around the table for everybody. Um, you need special. An opposite of it would be Kamdhenu. So Kamdhenu doesn't have that much shares. Promoter owns enough of the equity. Not a lot of chatter was there. Nobody kind of knew about it. Um, Everybody assumed they make steels. Asian Paint will kill the paint business. So there's not healthy chatter there, but it was available for very cheap price. Both the companies combined at one point of time in June last year was available for about 8 times earnings, and that now today has been from that price has been a six bagger. So it has to be evaluated on its own, and there are multiple factors that go into creating a special situation. It's just not that everything can be a special situation just because by the virtue of being spin off. So that's where I wanted to emphasize. Any questions there, I'll pause it till I figure out how to go to the next slide.
So, Tariq, I think Meet has made a very important point here. He
Yeah.
mentions that management change is a special situation if you play the arbitrage comparing open offer price with current market price. Not all, but selective. And
Yes.
can it be a good long-term bet or not is secondary thing.
Exactly. So the only caveat I will put there is Um, so we'll see in the next couple of slides is so Meetbai is right that you can do it for the arbitrage, but there are so many announcements. There are 1,200 announcements every day that happens on the stock exchange. So you have to narrow down based on where you want to invest in. I don't do open offers. I don't do like arbitrage. I don't do right issues. Like I don't do buybacks because there are so many of them happening all the time. And the max you can put in there is probably like you can earn 10 20 percent on let's say a 1 2% position. So it depends on where you want to focus at. I specifically focus on spin-offs, and the general reason being there is if there's a large enough spin-off with not many people know about it, I can build a very high value position in it at a very deep margin of safety. So for me, chances of losing money are less, but even if it goes 50%, I make a pretty significant return there. So that's where so instead of me kind of targeting 10 buybacks, I would rather focus my energies on one spin-off.
Right. Well said, Tariq.
Yeah.
So, Tariq, Jatin makes a point that sometimes arbitrage also doesn't play out,
Yeah.
like escorts. He gave the
Exactly.
example of escorts.
Exactly. So Escorts Kubota was a merger, change of management there, all of it. But again, it was a large cap company. Everybody know about it. So you have to. There are like qualitative factors and quantitative factors as well. So that's why I believe that there's no simple rule for special situation. You have to value these points across, and each of them will have its own kind of connotations around it. So you have to value, weight, and kind of use your better judgment to kind of figure out where you can kind of invest.
Yeah.
Yeah.
Tariq, you want to move ahead or?
Yeah, sure. I'll move ahead. Okay. So I'll show you a couple of slides around spin-offs, and this is some of the research is US, some of this is India. So spin-offs usually, if you look at it at a 3-year or a 5-year or 10-year period, this was in 2019 by Bloomberg. So they generally have a tendency of beating the market. And the caveat here I want to put it as is this is not a buy and hold investing. So even with spin-offs, there are cases of spin-offs where some good spin-off happened and you bought the company. There are people bought the company because it was cheap and then it became like 100 bagger over 10, 12 years. But most spin-offs and most special situation, you need to have an exit plan. You need to know what labels you're going to exit before you even enter. So this is not a buy and hold. You cannot sit on it just because it's a good company and you bought it at a cheap price. Like after a while, when everybody knows about such a situation, when post selling is over, it has reached its fair value, then you have to treat it as a normal company, and then you have to figure out, okay, whether your goal of and the target that you set while entering the position, you have kind of reached it. Has the market kind of over way blown past that normal fair value? Is it kind of expensive? So everybody knows, then probably it's kind of some time to get out of the table as well. But then it again is depending on you and your investing style. But the point that I'll highlight there is that once that period is over, then it's no longer a special situation. You have to kind of consider the normal company. And if you're a pure special situation investor, you have to book your profits. So not a buy and hold. You have to have an exit plan before you even enter. So this was a study conducted between 1963 to 1988, and S&P 500. All the spin-offs, if you kind of take it, they have beaten S&P 500 by 10% every year during that almost 20 more than 20-year period. And this is a research by SBI Securities. You can Google it as well. So they evaluated all the spin-offs that happened between 2001 to 2016, and they had beaten Sensex by 36% every year. So there's obviously no matter what time period you take over the last, let's say 10, even 100 years, you will find this kind of style has the potential to beat your normal index returns. And the reason is behind information asymmetry. A lot of people don't know about it. If everybody knows about it, it's not a special situation. That's the rule. And if because a lot of people don't know about it, there's information asymmetry there. Spin-offs are usually tend to be smaller parts of the bigger parent. Uh, all of those kind of go into it and help you kind of beat those returns. So I will just pause there and kind of highlight a lot of special situations that happens. So one is stock buybacks. Now they happen pretty routinely in the Indian market. I have seen almost like easily 20, 30 of them happening in a year. Um, so the way to kind of participate is if you can, so you cannot first of all build a large position in it. If you have a big portfolio, this is here is pretty much useless to you because you can probably invest 1-2 lakh rupees in it. If you invest larger positions, you have to it probably won't get all of it won't get accepted in buyback. So you have to kind of do a lot of calculation, and then the amount of returns here is probably about 10-20% in a very healthy scenario. And so it depends again on buyback to buyback, but I usually ignore it because there are too many of them and there's not enough ability to kind of research all of that, and you can't build a large position there. Mergers, they are far and few in India. They happen quite rarely. The trick to mergers is that you have to evaluate whether both the companies after merger will be worth more. And what are if one company is acquiring the other one at a cheap price? So again, there's an arbitrage play here. So the latest example would have been about Equitas Bank. And Small Finance Bank. So there was a merger there. There was a lot of arbitrage in the price. But again, once the price is synced down, you have to get out if you don't plan to hold the company. So again, like not a ability to kind of buy again arbitrage play. You can probably have a better, larger position here compared to buybacks. But this is where the risk-free part of it comes to. If something is getting merged, then if the float is less, then there will be one of the entity and the float is high another. There will be mismatches for a long duration. For example, if you take SDFC Bank and SDFC merger, it has been very well covered. There's I don't know how many crores of shares are there, but that's not a play where I would personally participate. If you compare it with Equitas Bank, you would see how fairly easy Equitas Bank was, and there was a big arbitrage there. The earlier you kind of started tracking, whereas in SDFC, since the deal was announced, there's probably like not even 10% arbitrage there. Capital structure changes. So these are far and few. And this basically depends. What I mean by this is let's say there's a large debt and that kind of goes away. Or a company sells a big part of its business and gives a special dividend. So again, there's an arbitrage play here. There's not something that you can buy a lot and kind of just um, uh, go and carry on with it. Promoter change, we talked about it. It depends on company to company and it's again an arbitrage. You cannot, uh, first of all, a promoter change doesn't really do anything other than get the street excited for a quarter or two, unless there's something that the promoter does in the first 3 quarters. There's not going to be a lot there. So you have to play the arbitrage there. And this is again not a buy and hold. Litigation and regulatory issue things are there when let's say a Supreme Court or Ministry of Commerce or whatever Ministry of Finance puts a custom duty or removes a custom duty. So one of the perfect examples here was Borosil Renewable when it spin off. Um, Plus, a few months down the line, they got a custom duty from Ministry of Finance on anti-dumping duty on solar glass. So structure, the structure of the industry changed. regulations change, which allows the company to suddenly sell it at a higher price or even match the price or get some sort of a benefit. So those are there. So your PLI schemes are also part of this. So you have to again see what the impact would be, and you have to study it deeply. So bankruptcy resolutions, so these are usually turnarounds and stuff. Uh, RACL was an example of it. So RACL was initially a bankrupt company. Somebody took it over, cleaned it up, and then turn around it, and you'll see what the price has been in the last 3 years, and how beautifully the new owners have turned it out. So again, depends on so any resolutions that you see, you have to follow it over a period of time. These are not like you just got to know about it, you invest in it, and then 6 months down the line you can exit out of it. Um, so acquisitions are simple to like mergers. You have to again like depend on what the company is acquiring. Shareholder activism is not really seen that much in India. It's usually US one. Uh, Tender offers and open offers. So this is an interesting area, and this is something that I practice. You have to in this situation, what happens is, let's say there's a small company, sub 100 crores, doesn't really do a lot of business, but there's a promoter who's acquiring it, and at that point of time, you have to research the promoter rather than the company. The company will be really bad. It will not look great on fundamentals. It has not done anything. Um, but you have to look at what the business the company is doing, and what the credibility of the promoter that's bringing in. And how do you research a promoter? You look at their directorships, you look at their business history, you look at what they have done. An example here I would take is Solex, which is a solar company. I came across it in March, I think 2021. It was about 30, $25 at that point of time. It was a very tiny company. It was one of the first companies in India that started doing solar, had solar street lamps, and does government tenders for solar street lamps and things like that. Now, it was a very bad company. Their uh, annual report and annual meeting was a joke. Like if you, there's some videos as well. I have written a thread on Value Picker as well. You can look at it. Um, but the key trigger was is that this external guy called Chetan Shah was acquiring it. Now, Chetan Shah is a he's associated with Goldie Solar, which is one of the bigger solar companies out of Surat. And so the guy knows about what solar business is. He knew about uh, he's done like 20 something years of experience. He has deep pockets, which is very important. If some guy who doesn't have enough money to invest in the business and grow it, if he acquires it, there's nothing's going to do to you as a shareholder. So this person had checked all those boxes, and then he acquired the company. He has completely changed it now. So they have about almost 1 gigawatt of capacity from something that they were doing tenders for just street lamps. Now they're doing 1 gigawatt capacity and still doing government work, but at a very larger scale. And winning most of the contracts from the government. So you see what the stock price has been from $25 is now almost $500. So again, it depends on who is acquiring it. There are a lot of tender offers that happen in India, and if you look at like if you go through all the announcements on a daily basis, you'll see a lot of them are, I would say 90%, more than 90% of them are useless. So you have to really deep dive on who is buying it and whether it's worth buying it. Um, then you have spin-offs, which is we have covered in detail. So this is an area where I practice, and we'll look at a couple of them as well. Rights issues is again similar to buybacks. You won't make a lot of money here. There are plenty of right issues there. Like you have to really, unless you have a lot of time, I don't think everybody can kind of track every right issues, and you make 10-20%. So I don't kind of deal in those. So I'll pause there for a minute. Any questions on the types of special situations before we proceed?
I see Meet raising his hand. So Meet, you can go ahead and ask your question.
Hello, Ankit bhai.
Hey,
Hey,
Mig bhai.
Uh, Hi, Tariq bhai. Amazing presentation, Tariq bhai.
Thank you.
Okay, Tariq bhai, just want to share something with you that you have said that not all open offers or demergers are special situation. I understand that completely, but the way मतलब मैंने मैसेज इसलिए किया but the way I look at open offer is कि उसको हम क्या long term के लिए रख सकते हैं या नहीं. Example I just tell you, in 2012 a guy called Sudhir Jatia acquired Safari. Safari was near bankrupt company, right? So Sudhir Jatia came from a very rich background, VIP Industries, right? At that time also VIP was the second largest or third largest player. First one was Samsonite, second one was I guess VIP. So he invested 80% of his net worth in one single company. So he has got 15-20 years of experience with him, and he has got 15-20 years of runway ahead of him. And the guy has invested 80% of his net worth in the same line of business जो वीआईपी में वो काम कर रहा था, एंड मार्केट लीडिंग बैकग्राउंड. सो आई थिंक वो एक स्पेशल सिचुएशन होती है कि वो हमें डिकेडल ऑफर मतलब अपॉर्चुनिटी देती है कि इसमें हम बड़ा पैसा बना सकते हैं या नहीं बना सकते हैं. Another example is few years back in 2018, APL Apollo acquired Best Logistics at around 200 or 300 crore market cap. Okay, sorry, 150 crore market cap. So the catch was कि 150 करोड़ का कंपनी है एंड संजय गुप्ता इज इन्वेस्टिंग 150 करोड़ इन दैट कंपनी. सो आप समझ लो कि जितना मार्केट कैप है उतना ही केपेक्स आ रहा है, right? So I think this is the kind of special situation we get in once in 4, 5, 10 years. Another example is SG FinServ, Mungipa Securities. Sanjay Gupta
Yeah.
again acquired that company and infused money via preferential at 100 rupees, 200 rupees. He acquired the company via open offer, 17 rupees, then revised the open offer 57 rupees. And in 1 year, the price is at around 550. And 2 days pehle result aaya, and you see the fantastic change in the balance sheet as well. So the question is whether you look open offer purely on the basis of exits, or you think that open offer में हमें long term कोई decadal opportunity भी मिल सकता है, या आपका कैसे मतलब व्यू पॉइंट रहता है वहां पे?
Yeah, so I do open offers, like you said. You have to look at the promoter or whoever is buying, making the open offer and acquiring the company rather than the company itself, because company will be shit. So it's the promoter. For example, all the examples that you gave around Safari, for example, he had put, so the promoter knew about the industry. Obviously, he was working in VIP. 80% of his wealth he was buying. Safari was a basically a bad company at that point. So that's kind of it. For me, honestly, nothing is long term. I am not in the business of writing books, so I like making money. So every investment has an exit date. It doesn't, for me, I don't believe in buy and hold, that you kind of just sit on it, and or coffee can or whatever different words are going around. Uh, every single investment that I make has a opportunity cost on it, has a cost of my money sitting there. So if I get an open offer, which is like what you said about Safari or Mungipa, for example, Mungipa didn't have enough float going around, so it was very less. Only a very few, lucky few got it. But there would be those kind of things are very, very less. So you wouldn't kind of find him very few, like you said, once or twice in 10 years you might get it. On a regular basis. Solex, for example, Solex was very you had shares available there, and it was about a 1 year period where you could accumulate, and that again has been a 10x in 2 years. So those kind of stuff will be pretty rare. And tender offers, I can give you the exact stats. I'll show you a dashboard later on. But tender offers happen, probably there are 200 300 tender offers in a year. So you have to evaluate all of them. 90% of them are crap. You have to look at like who's buying it, for example. So what you said, like you have to look at the promoter rather than the company itself, and those will be very rare. And in those cases, if I buy it, I would then kind of rely on technicals. I would rely on how much is getting noticed on the street. So very qualitative factors. And until I had before entry, like whatever I had mind, I would kind of stick till there. I would never think of it like a decadal run, because like for example, Safari is towards like the tail of it. In mathematical terms, like the probability of somebody buying and turning a Safari from less than 100 crore company to where it is today, um, and that's pretty rare. It doesn't happen. So in my that opinion, I would never kind of think about like a decadal kind of run. But that's just me.
Okay, okay. No, but in few cases, we don't care about companies' past, but we do care about promoters' past, and we do care
Yes.
about both future. You know, कि promoter ने क्या किया है, मतलब decadal wealth create की है, तो मतलब I think I am that kind of investor कि उनको एक दो चार bad quarters भी आता है, तो मतलब I am comfortable holding them.
Yeah.
But yeah, it's like कि मतलब there is no one size fits all.
Exactly.
So yeah, thank you.
So it depends
Thank you for
on the
your
person. Yeah.
yeah. Thank you, Tariq bhai.
Yeah.
Thank you.
But
Thank you, Meet,
but
please, for asking.
yeah, but the point here, like that there's definitely an ability to make the risk adjusted return part that we talked about. There's definitely an ability here to create high risk adjusted, like very low risk and very high return. So you can get a because if you get the right promoter, if you know about research, then the tender offers work pretty beautifully there.
If I have to summarize whatever both of you have discussed, of course, there will be decadal opportunities like Safari, but it is too hard to find. It's just like finding a needle in a haystack. So there will be many safaris which will not work out against one safari which will work out. So it's not that easy. It is easy to look back now at a safari which had done well and then say that it was a very good opportunity, right?
Yeah.
Great. So, Tariq, do you want to take more questions or you want to?
We can take more questions. That's fine. We have time.
Okay, great. So,
I see a lot of comments coming up, so let's do
yeah,
that.
so I have a lot of questions. So, Manojit Das, he asks a 200 crore company with 5-year profit, 64% CAGR, promoter buying from last 12 quarters, available at 15x with very low float of 16 lakh shares only. Do you consider this as a special situation?
No, but what's changing there? Is it a spin-off? Is it somebody acquiring it? There needs to be some catalyst there. Just because a company is growing with low float, it's not really a special situation. It's just a case of a low float company growing very well.
Right. Next question is from Apurva. Apurva says, what's your definition of everyone knowing or not knowing about it? Especially in today's time and era of social media and higher informed participants.
Sure. So everybody knowing, so I would say if a business channel is discussing it, that's definitely everybody knowing it. If it's in the media, if it's in the paper, that's definitely everybody knowing it. There are very few people who practice special situation that I know. They don't really talk about them a lot. Uh, I must be one of the outliers that kind of really speak about it. Most people don't talk about it. They try to kind of just talk among themselves. But there are very successful special situation investors, even in India, who have done very, very well for themselves. So, in my view, if something is being discussed in the media and if it's large enough, for example, Piramal was a pretty big company. If the size of the company is a giveaway. Size and the float. Basically, the first time I hear about a company undergoing a spin-off or a demerger or some whatever to do with special situation, the first thing I look at was the market cap. What's the float, and I go on Twitter and just search the term and how many people know about it and talk about it. So those are kind of the three things you can kind of guess with it.
Right. Good. So, Kamal asks, in a merger, the intangible goodwill amount is very difficult to fathom. And so, does it not make it risky?
Yeah, it does. So if you look at mergers versus spin-offs, the mergers tend to be less profitable compared to a spin-off. The reason I like spin-offs is because spin-offs is completely opposite of an IPO. An IPO is well groomed, well dressed. The decision is made by the company 2 years before the IPO comes. So then they are on their toes. They are perfecting everything. There's a team of 100 people of bankers is looking at every single detail thing in their financials, drafting a very beautiful IPO document, and doing all that jazz. Whereas in a spin-off, the company just has one board meeting, says, "Okay, I want to demerge this company," spins off, and that's it. There's no research notes before the spin-off. There's nothing of that sort. So that's why I like spin-offs. IPO is like just opposite of it. So in a merger, if you look at it, mergers are very comparatively less profitable. And a merger is comparatively much more difficult to also do from a company's perspective because there are two companies coming together. Um, how do you play a merger is for the arbitrage. For example, the recent example and the most famous one I'll give it to you is Warren Buffett was playing Activision and Microsoft's merger. And that was technically a merger, though Activision is too small compared to Microsoft. So you can term it as acquisition as well. Um, but Buffett bought uh, Activision shares, and then when he bought it, if you look at the last annual meeting, he said there's a regulatory risk, and towards I think in Feb this year, the regulatory risk was becoming evident. He sold off it. I think he didn't take a loss, or it was a single digit loss, but he was playing for the arbitrage, and that's it. The most you can do in a merger is probably the arbitrage.
Right. So the next question is from Shashikant. Right issues via partly paid up shares if issued by a good company. If partly paid up shares are trading at a discount, will that not be beneficial? Also, what is the mindset of promoter who apply for right issues? So there are
Yeah.
two questions here.
Yes. So the first one, so it will be beneficial. So all of these are beneficial, but like I said, like for me, special situations is where I can buy and build a large position. In a rights issue, I can probably it might be trading at a 20% discount, and partly paid up. Like I would not have to give it if it asks for $100, I will only have to give 50, and then the rest 50 at a later date. So uh, for me, I can't build a very large position in it. I can't go and buy put 10-20% of my portfolio in it. So for me, it's useless. I don't want to do that arbitrage. And there are the most I think in all of these, if not for buybacks, I think rights issue are the most prevalent in India. Every day you will find some company doing rights issues. So if I have to see my return on time invested, I have to analyze probably 1,000 right issues to find 10 of them that are worth it. And at that after that also I'll make 10-20 bucks percent on let's say 2 or 3% of my position size. So that's not worth for me. So if somebody has a small portfolio, they want to go through it, they have a lot of time, then for them there. So all of these will give you an arbitrage. In my opinion, I focus on such situations where I can make multiple times with a very less amount of risk.
Right. So Tariq, Sandeep asked two questions which are not directly related to special situation, but I think it is important. So, and I'm sure you must be having the answers.
Sure.
How to research on the promoters on such small companies, and what is your checklist and sources of information?
Sure.
Number one.
Yeah.
I'll ask the second question later. Yeah.
Oh, okay, cool. So the first part is how to research on the promoters. So you look at the promoters' history. So what I usually do, I go to LinkedIn, I try to find them if they are there. I sometimes stalk them on social media as well. I look at what I have gone to the extent of looking promoters' Twitter feed or their like history. I look at their directorships, if they own any directorships across, if there has been ever a media article about them. So everything on the internet gets archived. So there's a web archive. You can go search their name there. You'll find all related articles, everything that has been ever published around them on the internet. You will find it there. Then you can look at, so there's a Zuba Corp and things like that that are, or Toffler and things, places like that, where you can kind of key in a person's name. It'll tell you what other directorships the person has. That way you will get the company, and then you can research on the other private companies, what they are doing. So your job is to kind of guess and ascertain what kind of personality the promoter has. How does he react in kind of with interviews and things. There are a lot of companies I've rejected just because the promoter seems snobby on a business channel interview. And some of those companies had frauds later on. So, and some of those companies became very successful. So it's not 100% kind of thing, but I have to use my judgment to the best extent I can. So that's how you kind of do it. It's very hard to do. It's not very pretty much easily like how on a screener you will go and type a company name, every financial details is there. And that's why there are less number of participants in this. And because there are less amount of people participating, that's another one of the reasons why you get things available at a deep margin of safety for a extended period of time.
Right. So, Sandeep asked the next question is how to go through the exchange filing efficiently. And I think you are
Yes.
one of the best person to ask that.
Yes. So
Maybe
we
you
have
can.
we have slides and later on I'll show you 3 options to do it. And I'll kind of really discuss about it in the next few slides.
Great, great. So there are a few questions directly related to few stocks. You want me to take that up or
I
shall
don't want
we?
to do stock specific stuff.
Great.
Yeah.
Sure. No problem. No problem.
Cool. So
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 yeah,
let
I think we can go ahead with the presentation. There are more questions, but I'll ask later. No problem.
sure. Okay. So, so let's talk about spin-offs now, and how do I practice special situations? Mostly is spin-offs. I do takeovers and tender offers a little bit. I would say if I have to classify all of it, it's probably 10% of it, and 90% might be just spin-offs. Uh, so when a company is being spun off, you have to. It will always be that that company is now independent on itself. It will never be that a parent company just spins off a dying entity and puts it in the market. Um, Nobody is going to kind of do that. So that's your first clue. Some company is spinning off a smaller company from it. It's most likely that that company is now independent, and there's some catalyst in that company, in that business, that's going to happen in the next few months after spin-off or a year after spin-off. So you have to find that basically when you're researching it. You have to look for that reason of spin-off. Why is the company doing it? The business is flourishing. That's everybody knows that that's the reason doing it. But why is it flourishing, and what are the catalysts after the within 2 years or few months of the spin-off, and when are they going to play out? That's the focus of your research in there. Uh, Post, once the company spins off and gets listed, you have to look at insider behavior. If the insiders are buying it, that's a dead giveaway that that's basically insiders are buying company. You should be kind of looking at doing the same. Then I look at, is there extreme margin of safety? For me, extreme margin of safety is anything less than 50% discount of its fair value. Somebody asked how to do valuation. That's a very broad topic. But one of the ways is to kind of look at the peers, listed peers, look at their businesses. Is there something that is available at the same kind of a business, and the spun off business, is it cheaper than that business? So that's one of the kind of crude ways of doing it. But the real way of putting valuation stuff, you have to analyze a business end to end. You have to look at financials. You have to kind of model and things and have assumptions and uh, do all that exercise on your own. Um, then look at the current investor profile. By that I mean, like, how much do the institutional investors own, how much do retail investors own, and how much do the promoters own. What kind of institutional investors are there? Institutional, just because FII holding is 10% doesn't mean it's a good FII. There are very bad FIIs as well who just kind of buy it and then dump it and then get out. So you have to kind of look at whether and judge to your best capability to look at whether that institutional investor is going to sell or not, and if when are they most likely to sell. Uh, Street awareness, I'll look at how much does the people know about it. And I told you how to kind of judge that. You can use social media, you can use keywords, you can look at business channel, what they're doing and things like that. And then finally, I look at float. For me, low float is more important, because if there's low float, India doesn't have concept of fractional shares. So float becomes very important. The lower the float, the more the volatility in the stock. So on the downside as well as the upside. So I'm looking at the downside volatility. If something listed 100 rupees has only 1 lakh shares, 50% is controlled by the promoter, and there are two FIs sitting that own 10% each. The 20,000 shares are going to get dumped in the market. There's probably it's gonna hit a few down circuits. So that's where you kind of need to ascertain, okay, how low can things get, and float kind of helps you judge that. So we'll talk about how to track special situations. So this was one of the questions somebody asked. So there are three ways to go about it, and all three of them are a derivative of your free website for BSE corporate announcements. So this is a free website on BSE. Every single announcement that ever happens, whether it's a NSE company or a BSE company, uh, comes to BSE corporate announcement page. NSE only listed companies, are there only 300 NSE only listed companies out of the 4,200 companies in the stock market. So it's very rare that an announcement will not be on a BSE as well. Those 300 companies, I think 50% of them are less than 100 crores, so I don't care about them. So you're missing, my point is that just monitoring BSE announcement, you're missing less than 1% of the total announcements. So start with BSC, and then if you have time, you can kind of look at NSC as well. But this is your holy grail. Most of the successful investors I know, at least the old school ones, they just go into this particular page, and they have over the years kind of learned how to track and look for keywords. And then you have other examples as well. So you have Screener. I'll show you in a minute how to kind of research there. But Screener has a very good functionality to just do by keywords. The only catch here is that they are very accurate, and that's not like, it's not good when you're trying to capture a large set of announcements. So for example, if you look for scheme of amalgamation, which is a keyword in mergers and demergers, then they are very accurate to the sense that if they give you 5, all 5 will be relevant. But the way to kind of study corporate announcements is that you need a little bit flexibility so that you don't get 5, you get 10 of them, out of which 2 are irrelevant, 3 are most likely relevant, and then 5 are definitely relevant. So that's where you need to focus on, and how to kind of that's how I do it. Um, but Screener works pretty well. So this is no way kind of a comment on them. I'm just saying that they're quite accurate there. Then there's paid tools as well. So Regulation 30 is kind of a so two guys run it. The guys who run it, the Shah Talwar and stuff, they're pretty they're very well experienced in special situations. So I have learned a lot from them. Like, and they are the guys who are pretty much nerds around mm, announcements. They know them very much in detail, and they're practicing lawyers, so that helps them a lot. Um, and then I'll show you an example of self-developed tech. So Regulation 30, you can research on your own. I'm just mentioning them. Screener.in and my self-developed tech, I'll show you. So let's do that. So I'll stop sharing for a minute, and then I'll open.
Guys, you can keep asking your question on the chat box. We'll take up all the questions. if Tariq has time.
Yeah, I have time. Time till 1, right? So good. Okay, can you see my screen for?
No, not yet.
Okay, now.
Yeah, now it is coming up. Yeah,
Okay,
now
cool.
we can see it. Great.
Okay, cool. So under screener, if once you log in, go to tools and go to latest announcements. So here basically, I've already have some keywords there. But what you can do is basically, so when you log in, all these things will not be available here. You have to add it. So the way to add it is add a filter, and you can just write the words around it. So let's say I want all investor presentations. So I'll write investor presentation, and I'll separate it by presentation. So those two you can add as many as you want. So I've just done 2, and I'll do search results. So it'll only show me investor presentations of all the announcements. And then the great part here, you can add an alert as well. So screener will automatically email you every day with all the announcements that are presentation. Now, remember, this is extremely accurate. So you won't get a third one, which may or may not be a presentation and then might be still be relevant. So this is the easiest way for you to start monitoring announcements. And I have a bunch of these for arrangement, which is mergers and demergers, rights, buybacks. So whatever you're interested in, you can add things like this, and it'll kind of come in. So once I add alert, it'll start sending emails as well to me now. And if you see every day, they'll kind of just highlight all the investor presentations here to you. So any questions on here?
Anyone, any questions on the screener? I think I don't see any question related to that.
Okay, cool. Okay, so now let me show you. So, okay. So can you see my, do you see a corporate announcement analysis page?
Yes, Tariq, I can see that.
Okay, cool. So this is my self-developed tech, and what I do basically, like I said, I want to be able to kind of look at across. So let me kind of refresh it. So what I have done is basically every day, at the end of the day, I've written Python scripts that kind of automatically go to that BSC website, scrape it, download that data, put it into a database. It also does tagging based on keywords, and kind of put them into categories. And then what I do is basically all of these I've kind of put in. So I'm only looking for announcements where I have a category. Now, for a particular, let's say, if I have to do it for this week, I have found about 1,000 announcements, and I'm pretty sure there were about 5,000 announcements. So that way I kind of reduced down 80% of them, and that I kind of can figure out. Even, for example, I don't care about dividends, press release and stuff. I care about merger, demergers and acquisitions. So I even, so that there are just 22 announcements out of the 4,001 that I need to kind of look at. So you can develop technology like this as well. So if I, for example, kind of will click here, I can get all the announcements made by this particular company through it based on my keywords. Um, so there's no shortage of what you can do. The only thing being is limited to what you want to kind of do it. But the holy grail is your BSC corporate announcement page. These are all just beautiful analytics on top of it, but that page still remains like the crux of everything. So let me go back to.
Tariq, before you go back to the presentation,
Yes,
few questions I see on the chat box related to these as announcement and
sure.
so somebody asks, let me just check who this is. So Abhishek asks, do we need to have a premium subscription for this facility? I don't think, screener, you need a premium for those things, right?
Screener, I don't think. My own tech, I don't share with anybody, so it's not. There's no subscription there or anything.
And Amit asks, in ad filter, what is the keyword we should use for tracking spin-offs?
Yes, so spin-offs, you need to use scheme of amalgamation. That's one. You can look at spin-off also as a keyword. Then what other keywords are there? You can look at a demerger as a keyword. And the easiest way for you to do is to look at actual demergers that happened in the last 2 years. Pull the announcements for them. They will be available there. It's much easier to search as well, and look at that document and then find a keyword there. So you, after you look at 20 documents, you will automatically start finding. I look at every day, look at over 200 keywords across all uh, various buckets and categories. And that way you can kind of, but even then it's not 100% accurate. So if you're looking, for example, if I put this particular keyword every time, it will be 100% accurate. That's not going to happen. You have to, this is a time investment part, so that's why you have to still kind of invest some amount of time. And most of the times you find duds, but there'll be one or two times which you will find something pretty great, and that's worth all the time that you invested before.
Right. A couple of more questions, Tariq, quickly.
Yeah.
So Jitendra asks, after spin-off, one gets a smaller company. DIIs and FIIs have to sell the smaller company because it doesn't fall in their investment strategy. At this point, share price falls. How to know when the selling by funds have been completed to enter, and how to know who sold?
Sure. So, couple of things around that. First, it's not always. There are no always rules in finance. So, it's not always that a spin-off happens and the price goes down because somebody insider is trying to sell it. That's usually what happens, but not always. The latest example I'll give you is Aarti Pharma. So, if you look at shareholder thing, they have sold almost 50% of it in the last 3 months. But look at what the price has done. It found a base and then it's gone up. So, so it's not necessarily always. And how do you know who's selling is you monitor. So mutual funds things are available. There are various tools available. There's something called a rupeevest.com where you can monitor monthly mutual fund buys and sells by a stock. And then there are lot of tools available. If it's a bulk deal, you will get to know in announcements as well. Then that way you can kind of easily monitor it. If it's not a bulk deal, then you wouldn't know who's selling it. But on a month-to-month basis, you can kind of do it. And it's also, once you kind of practice it enough, you will know who's the investor inside. So there are a lot of very famous FII funds who traditionally are known to kind of not keep spin-offs and they sell it. So that way you can kind of eventually figure out.
Right. So Sagar asks, any good special situation fund that we can follow?
So within India, I don't think there's any special situation funds. And the reason behind that is that this is not a strategy that works on a like you wouldn't find a special situation every other day or even a month. There are probably in a year you'll find two or three worth investing in, and they perform over a 18, 24-month period. So it doesn't suit the need for a fund or a pool of investors kind of pooling their money in. It's much better to practice it as an individual, because there you don't have all of these rules and limitations around it. If you find something which is selling for, let's say, 90% less than what it should be, you can even invest like 10, 20%, nobody's stopping you. But in a fund, they probably can't go above that. So it's very hard to kind of generate very high returns, especially in a market like India where most mutual fund guys are just looking to beat the index or remain with the index. They have no incentive at all to outperform, and kind of give very high returns. So you unfortunately there's nothing that I'm aware of, and even if there was, I wouldn't kind of subscribe to it.
I think the next best thing to do is follow people, individual investors, and maybe be friends with them. That can help a lot.
Yeah.
So Tariq is here for sure. Why I'm confusing Tariq and Tahir, I don't know.
That's okay.
So Tariq is here, and we have Vikas Kasturi. He is also present. He's our Mission Smile member and a very close friend of mine. Then we also have Mr. Gaurav Sood, and we had a presentation
Yeah.
with him as well last year. So when you follow these people and maybe be friends with a few of them, then you understand it much better, because
Yeah.
there you get the live case studies and you see what is working, what is not. Right. That
Yeah.
is, I think, the best way out.
Yeah, Meet Bhai also does it. He posts a lot about it on Twitter as well.
Exactly.
He can do it.
Meet has already discussed. Yeah, he
Yeah.
already asked me that question.
Yeah.
Yes.
So there will be a lot of people, and it's impossible for you to kind of just do it, because on any given day there are 1,200 announcements on just BSC portal, out of which 90% are useless. So you have to, most probably, like, you won't be able to kind of know everything about it.
Right. So Tariq, we can go to the presentation now.
Sure.
We'll
Okay.
again go back to
Yeah.
questions.
You're able to see my presentation screen, right?
Yes.
Okay, cool. So spin-offs, I'll talk about a couple recent examples, and I specifically chosen all of these because they are all five of them are different from each other. So Kamdhenu Paints was an example of investing before the spin-off, because the combined entity was available to you cheap. And again, the reason I'm highlighting from this slide is not to kind of give you these names, but to make you understand that each of these are different, and because of that, every special situation you have to evaluate it on its own. There's never a set rule that uh, is spin off, before spin off you have to invest, or after spin off only you have to invest, or this is a spin off, so that's why it's going to be beneficial. There are multiple factors that go into it, and you have to, all of these you have to once you start analyzing it on its own, that's where you kind of figure out whether it's worth investing in or not. The core idea being that if you can buy something at a cheaper price than what it will be, because after the catalyst plays out, spin-off is just a catalyst that allows individual companies to kind of get that valuation gap filled. Uh, so you still have to go ahead and kind of still in research these companies on its own. So Kamdhenu was before, like the Kamdhenu paints plus the traditional business was available for 8 times earnings, 8 times earnings of the parent company. Paints hasn't done nothing so far. Like it's not a very big part of it. Uh, so from there, if you were buying at 8 times earnings, whereas Asian Paints and things like that, and paint companies kind of being normally commanding high premiums. So that way you can kind of judge whether something was cheaper or not. Dave D Plastic Industries is one of the companies that I think Mission Smile has also kind of covered as an example. So here you had to buy it. It's a very tiny company. I'm pretty sure a lot of people don't know about it. I kind of also missed it. Uh, so this is an example of a very small, let's say not even a small cap, micro cap companies, kind of less than 500 crores, kind of demerging together and kind of building something. Aarti Pharma Labs, this is an example of a company where you couldn't buy before it. If you had bought it before, you probably wouldn't have kind of the individual company uh, plus the own company was a little bit steeper in valuation, or was fairly valued. So you had to wait for the spin-off and kind of judge based on the spin-off how much market is kind of valuing it, and then look at the peers. So in this, you have to look at existing API peers. You have to understand how this business is different from that listed peers, and kind of then figure out it. All Cargo Logistics, this is an example where very highly tracked firm, pretty one of the top two firms or three firms in logistics. But in June, July, I think you were getting this for 250 rupees, three companies together combined, which has an infrastructure business in it, real estate parks and logistics and things like that, which has a high asset business for inline containers and chains and things like that. And then you have a fast tracking, low asset and very high turnover global logistics business. So here is an example that was available for 250 rupees. After demerge, after spin-off also, this is now available at 250, 280. So you pretty much got the other two for free. Shipping Corporation of India is an example where the government is kind of demerging the two. But the catalyst here is not just the spin-off. It's the spin-off plus if it gets acquired. So, for example, if the land assets is already dematted but has not listed, but I'll take the example of BEML, which has a similar kind of thing. So BEML was again owned by government. They took the land assets out, put it into a separate company and spun that off. Now BEML land assets itself is worth 170 rupees a share. So if you were getting BEML at almost the same price that land assets one, your pretty much existing position in BEML is kind of free. So that's an example of where you all of these, the only thing in common is margin of safety. Unless you have margin of safety, you shouldn't kind of look into that. But the reason I wanted to highlight is that all of these are very different from each other. So last couple of slides. So these are two people. So one is Maurice Schiller. I don't know how many of you know about him, but he's the OG of special situation investing. He started doing special situation during the Depression era in US, and was one of the peers of the guy who kind of trained Warren Buffett. So John Graham and stuff. Whereas Joan Greenblatt is a kind of modern take on special situations. If you read, if you read the books, I have not listed every book of them, but blindly you can kind of take books from these guys and kind of read it. Maurice Schiller has written almost 6, 7, 8 books on special situation. All of them are amazing, and they are from 1940s, 50s era. So pretty like you, even though they are that old, it's still worth kind of studying it. Joel Greenblatt is the modern take. He specifically focuses on spin-offs. So he has a 35% CAGR kind of over a 9-year period, and he has never kind of had a drawdown year, mostly because he was investing in spin-offs. So these two people, you can Google the books for them. I didn't want to list every single book, so you can kind of look at that. The other book is this particular one, which is SEBI Takeover Code. It's a very like it's not a investor book like you will find these two, but I find it very important because this lists down all the regulations by SEBI that requires in takeover, buybacks, delistings, spin-offs, anything to do with special situations, which is the regulation 30 part of basically announcements. So that regulation 30 is described very much in great detail as to what companies have to do and what the process is. Because in India, that merger demerger process goes through NCLT, and that's a pretty long kind of period. And you have to kind of study this and know this as to how things works. And I don't think many people kind of do it. So this can kind of just studying this can kind of give you an edge or referring this. Yeah, that was it from me. I'm happy to answer all the questions.
Thank you so much, Tariq. So there are lots of questions. Let me just open the chat box and
Sure.
so Apurva asked this question. I think this is also a very important question. What's the largest allocation you take up to in one single stock? Like how much percentage of your portfolio you would have invested in something like an Aarti Pharma Labs?
So I don't discuss existing positions, but I can tell you I don't hesitate going in double digits, high double digits. Um, I'm a pretty concentrated investor that way. So if something is available for cheap, I'll not hesitate kind of making a chunky position in it.
Okay, there are many questions related to specific businesses which I'll avoid.
Yeah.
How do you again bio? Okay, most of the questions are stock specific, which I don't think you are willing to take up.
Yeah, I'm not a registered advisor, so I don't want any legal trouble. So
if anyone wants to ask any question, you can just raise your hands. So I see one hand being raised by Sriparna Pal. So Sriparna, you can go ahead.
Yeah, hi. Thanks, Ankit. Hi, Tariq.
hello.
So my question is, I saw an example of Kamdhenu paints here, and you compared that to Asian paints. But the story that we hear around Asian paints is it has got a specific strategy for which it has a very great market share and it will always have. So how do you take a decision in such case? Because I mean, we do not know what strategy Kamdhenu Paints has and whether it will ever be able to catch up with Asian Paints.
Sure, yes. So I didn't compare it one-on-one basis to Asian Paints. My point there was that Kamdhenu company, the existing steel business as well as the paint business together was available at 8 times earnings in June when the sell of when market was going down. So how do I as a kind of potential investor when I'm trying to assess the company, of this spin-off hadn't happened at that point of time. They were going to spin it off and list in a few months. But I have to judge whether the combined entity itself is cheap or should I wait for the spin-off. So because the spin-off was happening in a paint business, you have to look at all the existing listed peers of paint. So you have Berger, you have Nerolac, you have Kamdhenu, you have Nippon Paints. There are many other paint companies that are coming through. Birla guys are doing it. So I don't know what the valuation of Kamdhenu Paint should be, but I know that there's definitely paints as a theme is going around in the market. So that much I can be sure of. Then I need to look at what the valuation of these companies are uh, in with regards to their capacity, and then I can kind of compare it with Kamdhenu Paints and its capacity or whatever the plant management has to kind of judge and ascertain what can be as a very conservative valuation to it. On the basis of that valuation, I can decide whether the listed entities together with the business of the steel is cheaper or should I wait for the spin off. That's the entire point of view. Uh, the only part you're looking for is the margin of safety in it. If things are of a value of, let's say, even on a normal scale, if something should be valued at 10 rupees, if it's available at 5 today or less than 5 or whatever is the case, uh, that's what you're trying to assess. I personally never project and kind of say, okay, uh, this can compete with Asian Paints or this can become that high valuation or whatnot. That's why I said like nothing is decadal for me. I'm only looking at if I invest 100 rupees today, what are my chances of losing that 100 rupees? And if that chance is less, then I'll take that bet.
Thanks, Sriparna. Do you have any further question or the
Yeah,
question
thank
has been
you.
answered?
Yeah, one more question is, do you also look at the industry, meaning whether because there are some industries that are like buzzing, at least that are buzzing as the keywords like EV or solar. So, do you also look at the industries
Yeah, and does look at it as in like while researching or the company or
while
I guess
picking up the companies to research? Meaning, of course, you
yeah.
are looking at the spin-offs, but
Yeah.
does the industry also matter to you?
Um, to an extent, so you can't be because spin-offs are like pretty. There are not so many of them. You will probably get a handful of them in a year. You can't be choosy. So I look at whether there's margin of safety, and I look at the history of the company more than the industry. So industry doesn't matter. If something is cheap after spin-off, after for selling, market will kind of eventually will make it at fair value. But it depends more on the company. For example, I'll give you an example of live example going on. So Edelweiss is trying to demerge its wealth management business from itself. Now, if you look at the history of Edelweiss, it's not great. There's a lot of been frauds and problems and things like that. So I would personally kind of not pay that much or allocate that much time in researching it. Wealth management on its own, like you can look at Anand Rathi, you can look at what the brokerage guys are doing, or ICICI and all those things. You can kind of ascertain, okay, what might be the value of it. But on its own, I might not consider it, but I'll still study it to the extent that I know things about it. And then if I know that wealth management business of Edelweiss, let's say 1,000 crores, uh, and it gets a valuation of after spin-off for, let's say, 400 crores, and I know its valuation at least should be 1,000 crores. I'm just making these numbers up. At that point of time, I may take it as a bet, just for the arbitrage of it. But for me, all of this kind of goes in deciding as to how much time I need to allocate to research to a particular spin-off. So that's an example. I hope kind of that helps.
Okay. Yeah, thank you. Ankit, do I have time for another question? Is it okay?
Yeah, I see 5-6 hands being raised. So yeah,
Okay,
you
I'll just be
Yeah.
quick. I'll
Yeah,
just be quick.
that's fine.
Since you have taken the name of Edelweiss, that particularly interested me because Manish Pabrai has a position in Edelweiss, right? So
Yeah, it's good for Manish Pabrai. I'm not
okay.
Manish Pabrai.
Yeah. So and do you look at what like the known investors is doing, meaning people
Not,
who take more than
I'll look at it, but it won't be that high weightage in my, like, I mean, I don't go beyond like what others are doing. They have their own thought process. The only thing I can trust is my thought process. So,
Okay. Thank you.
yeah.
Thanks.
thank you, Sriparna. Next in line is Jitendra Mehta ji. I'll just unmute you. Yeah, you can ask your question now. Jitendra ji, I have unmuted you. You may ask your question. Okay. So I'll go next. Vikas, I have unmuted you. You may ask your question.
Am I audible?
Hello.
Yeah.
Yeah, good. I can hear you.
Vikas,
Yeah. So thank you, Tariq bhai. Thank you, Ankit. I thought I knew something about special situations. ये session के बाद I feel there is so much to learn. Thank you so much.
Thank you.
I made like 3 pages worth of notes.
Yeah, even I'm learning. So if you talk to me in a year, I'll probably have, I'll
Tariq,
have
I'll
more.
come in here.
Yeah.
I think both of you should definitely meet. You both are in Bangalore.
Okay.
Vikas also has been doing special situation for a long time now. So I think
Nice.
both of you might learn from each other.
Definitely.
Yeah,
Yeah.
go ahead, Vikas.
I'll tell you, like, I don't know. I'm not an expert. So Ankit bhai asked me to present, and like I said at the start, I'm very much learning. So even 2 years down the line, if you ask me, I probably will say something else.
Yeah, I only bring those experts who don't call them experts. Even Vikas says the same. So don't
That's a
worry.
good rule.
Thank you, Ankit. Thank you, Tariq bhai. I have 3 questions.
Yeah.
Do you look at your special situations with a separate P&L, separate from your
Yeah.
say long-term holdings? Do you do that?
No, I kind of everything mixed. For me, what matters is like a 3-year CAGR or 5-year CAGR. So I kind of monitor my portfolio on a monthly basis on what it's doing, but that doesn't go into making my decisions because for me, I don't have to like publish my performance every year or compete. So it's all kind of mixed together.
Okay, thanks. Second question was when you decide to invest in a potential situation, do you have a minimum IRR threshold that you look for?
Yeah, so it depends on, so it cannot be an arbitrage. So for me, what matters is if I can, let's say, put more than 10% of my portfolio in it, that's one. And two, if I can see at least like since I do mostly spin-offs, like 50% or even like a double digit, more than 20-30% is not really like unheard of. So that's where I kind of focus at. And based on that, I kind of figure out after the spin-off, how much discount is there? So all of that goes into consideration to deciding how chunky of a position I can do and what my time to investment should be. And based on that, how after that is what market does. So that depends on it.
And one last question was any red flags that that we should watch out for in the
Yes. So
in the kind of in the kind of investing you just spoke about.
yes. So that like this is all riddled with red flags. So that's why like spin-offs you will probably find less. So in spin-off, I would say you don't know what the end portfolio and financials are going to look like. So it might be that a company is spinning off just to kind of put a lot of debt into that spin-off company or get rid of the debt at the parent firm. So you have to very deeply research the financials, and you should have some sort of an idea of what the balance sheet is going to look like of the spin-off firm. It doesn't matter, cash flow, P&L doesn't matter, but balance sheet is the most important, because balance sheet is going to tell you whether the spin-off company is going to survive or thrive. If it doesn't survive, then probably back off, and then you need to look at post the spin-off and how do you find the spin-off kind of thing. You have to for example, in Aarti Pharma's case, I had to go through Aarti Industries 10-year annual reports and kind of screen through all the annual reports page by page to get out data for Aarti Pharma's business. They were reporting separately, but I could kind of, because they were reporting it separately from the start, and they are one of the better firms when it comes to corporate governance in India, you could get that easily. In the smaller companies, you wouldn't even know. So you have to have some sort of a judgment there, and I would focus on balance sheet. So those are some of the red flags. You also look at what the company is planning to do post it. If it's spinning off and then trying to sell it off immediately. What are basically their reasons behind a spin-off? That will tell you everything about. In case for Aarti Pharma, the person is spinning off to give it to his daughter. So I would not consider it as like a red flag there, because the reason behind it is kind of they're doing whatever doing with their family businesses. But in some cases, people usually spin off a dying business just so they can sell it at a cheap price, uh, or they can get the debt out of their parent company, put it in the spin-off company, things like that.
Thank you, Tariq. Thank you, Ankit.
Yeah.
Thank you, Vikas. Jitendra ji, I unmuted you again. You may ask your question. I think you.
Thank you, Tariq bhai. Nice presentation, nice learning about the special situation.
Thank you.
Tariq bhai, wherever you are investing in the special situation, are you meeting the promoter and find out how they are, their integrity and all those things?
No, I don't do any of it. So my investing is between me and, like, I don't talk to a lot of people. I don't kind of even go and meet promoters. I do look at promoters, old interviews and old things. I try to find out, for example, if in a particular year if a company is going through troubles, I'll look at all the media interviews and how the promoter kind of behaves during those times and what he actually says, uh, and then kind of look at in con calls and results as to what he said. Did he actually do it or didn't do it? That is more than enough kind of for me to kind of judge a promoter. One-on-one basis, I've never even called a investor relation team.
The reason for asking, if we feel promoter is good, then our allocation, you may put more, or sometimes we don't know how much allocation we put in particular specific special situation.
Yeah, but in my view, and this is just me and my personal opinion, like, your process of investing should be your own. Like, it shouldn't have external factors depending on it. For example, if you always have to talk to a promoter, um, it basically brings out biases in your process. So my process, I try to engineer it in a way that it's all data dependent. If a company kind of, I can judge enough of a company just through its financials, just through what it has reported. Um, I don't really need to talk to somebody. So that's why, like, Ankit Bhai, I know him for almost a year now. I have never discussed a stock to them or an investment opportunity with him, and neither has he. So we kind of follow our own processes, and I am very particular about not letting other people's biases or kind of other people's judgment influence me. So that's just me.
Thank you. Thank you.
Thank you, Jitendraji. And Tariq, it's a very valid point you have raised. So I thought that I'll just put one point from my side.
Yeah.
So there are no one way of doing investing. So there are people who invest after meeting promoter. That is good for them. It's okay if they are meeting. But many a times we see individual investors saying that, oh, we don't have access to promoters. That's why we are cursed. That is like taking a defensive approach to anything in life. I don't think that is what is required or is a must to do in investing. Even I am not a big fan of meeting promoters, even though I've met a few promoters, but I also believe in most of the companies nowadays, at least, you find lots and lots of information on the internet, and videos are there, some interviews are there. So it is not a compulsion that you have to just meet the promoter, because the big guys also meet promoters.
True.
So that is what I thought I'll just put
And
it up.
they can't even discuss like anything. I don't know how it used to happen 10 years ago, but now I think if they do a call, like they have to record it and publish that call on the exchange as well. And
Exactly.
most of the people can't discuss anything what they have actually had told in the public. So if they may even make a new presentation, they have to publish that presentation on the exchange.
So Tariq, next time unmuting Mr. Jiten Parmar.
Oh, okay. Hello, sir. Hi, Jitin, sir.
Hi, Tariq. Very good presentation.
Thank you.
Very detailed and covered a lot of areas. So, I mean, I'm just here to learn. But just one advice I will give to everybody who is doing special situations. It is very, very important to understand the business underlying. So, I think you have already made that point, but I want to stress that because there are a lot of things which can go wrong in special situations also. So you need to understand the business underlying and then do it. And I agree. And one point I want to make: a special situation is not special if everybody knows about it.
Exactly.
So, yes, I think those who follow special situations do keep, to themselves, and I think that's the best way to do it. Otherwise, it will never be a special situation anymore if everybody knows about it.
Yeah.
So, I know it's kind of very secretive. I know a lot of good guys who are superb in special situations, but I've never seen them talk. Okay,
Yeah.
so it's good that Tariq is at least sharing all this with the public, and so that they can also delve into this, learn how to do this, and so thanks for this presentation, Tariq.
No, thank you, sir. I have learned a lot from you. So I
Thank you
don't.
so much.
Yeah.
Thank you so much, Jiten sir, for sharing your wisdom and years of experience here. Thank you so much. Really appreciate that. Thank you. So next I'll come to, let me just check. I think maybe Jiten sir wanted to say something. Sir, maybe you would have muted yourself by mistake. I've unmuted you again. You wanted to say something else?
No, I think that's it's a good starting point which Tariq has given to all of us. So we should work hard and basically uh, try to do this particular type of investing. We also do this as and when situations are available.
Yeah.
And there could be some other ways also. I think a lot of what we track is fund flows and fund outflows also bring a lot of special situations. There are companies where certain mutual fund manager changes, and then he has a new style, and he will basically want to get rid of a stock or something. So what we do is we track that quite closely if we understand the business, if we see value in it, and try to basically time our purchases, because what happens is this kind of selling brings the price down quite a bit, and a lot of times it becomes very attractive. Again, most important thing is you have to understand the business.
True.
And this also presents a lot of opportunities, uh, and we have seen that over the years. Even not only mutual funds, but there are private equity funds who are at the end of stage of their fund, and they will want to exit. They have big positions, they have to sell. That is another one. I don't know if that has been covered or not. uh, these kind of special situations also arise in the markets, and if you track closely, and if you know are diligent, and understand that, and don't wait for the last 1%, because that will get over in a jiffy also a lot of times. So generally we try to basically stagger a purchase. Let's say a fund is at 8%, has come down to, let's say, 3 to 2% or something. That is when we will start buying, and try to, something like that is what we apply also. uh, so that is one aspect everybody can look at.
Yeah. I
Thank you
agree.
so
Like
much.
you said, like it has to be the research first. So special situation is just an excuse to kind of, if you want margin of safety in good fundamental companies, this is one of, like, spin-offs are one of the way within it, special situations to kind of get that. It's not always that every spin-off is a good one, but if you research it, you may find like something which is worthwhile.
Right, right. Thank you so much, Jiten sir, for sharing your views and experience.
Welcome.
Thank you.
Thank you, sir. Yeah.
I'll move on to Dhruv now. So Dhruv, I've unmuted you. You can ask your question.
Hello, Tariq sir. I've been
Hello.
following your work in Twitter since long time. Hello, am I audible?
Yeah,
Yeah,
I can
Dhruv,
hear you.
before you start, I'll just mention here. So Tariq, you mentioned about Dave Plastic. So that research was done by Dhruv only. Dhruv
Oh,
is from our
nice.
team.
Hi,
Martin
Dhruv.
sir.
Nice.
Thank
So you know
you.
all about it. So
No, actually, I've been following you for so long. Like, I still use sometimes your special situations tracker in that Invest Karo website. So that was initially the only way that I knew how to track these spin-offs. So
yeah.
later, as I did more research, so I got to know other ways. But yeah, my question was regarding open offers. So I won't take the company specific name, like, but just to know an example, like if some new promoter is trying to enter the business by giving an open offer for say a 30-40% stake, but the open offer price is lower than the current market price, maybe because the stock ran up post the news. So how do you evaluate that opportunity? Like, do you think that maybe the open offer will, you decide whether to invest or not on the probability that the open offer will succeed or not? या फिर you think कि since the gap between the current market price and the open offer is not that much, so maybe he will increase the open offer price, या फिर some shareholders might still tender. Yep. What is the thought process behind that? I want
Yes.
to know.
So my personal view is like I don't practice those kind of things. So anything related to arbitrage or like 10-20% profit or इसका price अभी 10 है कल 20 हो जाएगा, that I don't do. Um, the only area where I'm observing and studying open offers is where a credible external person wants to acquire a company, and he or she knows about that industry which the company is doing it. So you will find, if you kind of look at open offers and takeovers, you will find all these 10 crore companies to 5 crore companies. Every day somebody is buying them, every day somebody is selling them. And some unknown person is buying it, some unknown person is selling it. But within those, you will find very rarely that, let's say, a sub 100 crore company, somebody is buying it. Mostly because they want to kind of reverse list it. So they have an existing business, they don't want to go through the IPO process, they want to buy a shell company sub 100 crores and merge it together. And shell companies, basically there are lots and lots of companies sub 100 crores listed on BSE that do not have any business, but for some reason they are just listed and they're paying the listing fees and whatnot. So usually those are the areas. There's an existing live one going on. I can't take the name because it's very small. But basically an unlisted microfinance and app-based finance kind of business is buying a listed shell company and kind of reverse merging it, and the promoter who's bought it has some kind of he's a pretty famous name in the finance industry, in the microfinance world. Also has some kind of bad rep. Also, some things have failed that he has done. Uh, but just that promoters being there and kind of buying it, um, and this company that's listed is pretty like, it was a shell company, 10-20 crores. So it's a way for them to kind of reverse list. So in those kind of things, I'm looking at an open offer, I'm looking at takeover. So open offer is just a way for me to kind of get an alert around that takeover. If that takeover is comes under this kind of categories, then I'll study it further, research it further. But then again, if it depends on how good the promoter is, or whoever is buying is what's their profile like, and how much float is available. If it's a very tiny float, I can't buy a lot of it because I'll have liquidity issues. I can't exit it if something goes wrong. So all of those kind of go into consideration on me deciding to buy something or even monitor it and things like that.
Got it. So just to extend on this example, like say the promoter is good, new promoter is good, and the open offer seems fair, but the price for the open offer is lower than the current market price. So we know that if this promoter comes, then the long-term prospects might improve for the company.
Yeah.
But primarily due to the open offer price being lower than the current market price, some shareholders might not tender their shares simply because why would they sell the shares to new promoter at a loss? So I
Yes.
wanted to know like,
So
yeah,
if in let's say in a mid cap company, if that's happening, that's a very different story because people know about it. It will be covered in media. Uh, if it's happening in a small cap or a micro cap company, it's again a different story because in those cases, most likely, even if the current price is higher, somebody will uh, render their shares just because they want a liquidity or they want to get out or whatever the reason is. Or most likely in these small companies, people know each other who are the shareholders, and whoever has 10% or 9%, they'll kind of they'll render some shares. So it doesn't matter that much in a smaller cap company, but it matters a lot in a mid cap company. That's the point that I'm trying to highlight.
got it, got it. That was very insightful. Thank you so much. And thanks for the webinar. It's very good.
So thank you to SmartSync and Ankit Bhai for arranging it.
Thank you, Dhruv, for your question. So next I'll ask Sandeep. Sandeep, I have unmuted you. You may go ahead with your question. Sandeep?
Hello,
Yeah.
am I audible?
Yeah.
Your voice is a little low. If you can just maybe increase the volume.
Better?
Yeah, I can hear you. We can.
Okay, go ahead, go ahead.
Yeah. First of all, nice to see you, Ankit, after a long time. So Ankit is actually my batchmate. Tariq, couple of questions. So does the strategy change by market cap?
So it's not.
Sandeep,
Yeah.
Sandeep, I think it would be better if you remove the that thing and directly use the computer, because in the recording your voice will not be done then. Yeah.
Yeah. Is it better now? Is it?
Tariq, can you hear his questions?
Yeah, I can hear it. So I'll just kind of announce his question. So his
Sure.
question was, does the strategy change by market cap? So it's a broad kind of strategy, but I'll tell you what I do. So for me, because I'm only interested in spin-offs, it doesn't matter what the market cap is. It matters what the float is, and how well it's kind of known, and if I like the existing company on its own. So for me, special situation is just an excuse, and a spin-off is an excuse to buy something at a margin of safety. Um, if the same thing, instead of a spin-off, if somebody had done an IPO, I would have not gotten any margin of safety. It's just that in the spin-off, there's some margin of safety. So for me, the entire process of research work remains the same. It's just that because of a spin-off, I'm getting the additional benefit of a margin of safety included in that kind of position taking process, and that kind of impacts how much position I can do and how long kind of I can stay invested. Um, for me, because spin-offs, like even when the company is being spun off, you don't know what market cap the street is going to do or the market is going to provide it. So you can't really kind of judge it or filter out just by based on market caps. And I like to be present across all market caps, irrespective. I usually don't look at anything sub 500 crores because that's 50% of the industry, of the listed companies out of the 4,200. So 2,400 are less than 500 crores. So I don't look at that individual basis, but if there's a spin off happening and the market cap may be less than 500 crores, I'll look at it.
Okay. Thanks, Tariq. So just one question on the tool that you have made. So like, just wanting to understand, like, is there, because I myself actually tried my hands at web scraping through Python. So is it any particular API or something? Because it didn't actually work on BSc website, and then I left it. So is there any particular API or that you have created, or how is that? If you can just
So
give
there's no API. So BSc unfortunately doesn't have an API. Most of it people have made like a scraper on and hosted on GitHub or somewhere. The way I do it is I use a library in Python called, excuse me, Selenium. And Selenium basically is a web automation kind of a library where it can on every website there are like tags on it, so it can go and kind of interact with the website. So on BSc you have click buttons and stuff. You can automate that kind of stuff, and that's been my approach. So it goes and kind of in the background opens a Chrome, uh, puts the link, selects the date, clicks on submit and all of that, and then tries to click on everything and then scrape it. So that kind of gets put it into a SQL database. From there, I run kind of another algorithm that kind of goes through all the keywords and puts them into categories. There are again cases where there are certain phrases that I don't want. For example, I've gone to the extent where, let's say there are 10 keywords, but if there are 10 keywords and there are these phrases also present, then don't flag it to me. So it's kind of a work in progress, it keeps on building. But that's the general kind of high level view of how I'm doing it.
Okay, thanks, Tariq. Let me try and write that again. Thank you.
Yeah.
Thanks, Ankit. Thank you.
Thanks, Sandeep. Nice to see you. I'll now go to Kailash. Yeah, Kailash, I've unmuted you.
Oh.
Yeah,
Hello.
go ahead.
Yes, hi, Tariq, sir. Actually, thanks a lot actually for your great insights. And sir, actually, you can call it a question or actually maybe a clarification. But my question is actually, I have a very special relationship with, this, kind of situation because of Max India's two demergers, has changed the financial era of my life. So those were the two kind of the special mergers, that were of a kind of a nature that has, shocked me, or whatever you can say. So my question is, sir, does the parent's balance sheet offers clear-cut insights that actually what is going to happen? Or because of the kind of the listing, the kind of contrasting listing that I had seen on the listing, maybe you can take the recent example of Pramil Pharma. So I'm not a numbers guy, so annual report is not my forte, but the point I'm trying to ask you, does balance sheet offers the clear-cut roadmap, just in the case of this Borosil Limited, actually coming the merger. So does this balance sheet offers that kind of insights that is absolutely clear and there will be no sharpener? Because the kind of the listing, if you had tracked Max India, so you would be knowing what kind of a listing actually we had seen and where are they right now.
Yeah.
And the kind of listing Pramil Pharma had seen. So it's my very specific question. This is first question, sir. I think you can answer this.
Yeah. So in my opinion, I don't think there's any clear cut thing across finance. Like there is no formula, there is no even a hand kind of a rule that if this happens, then this will happen. In my view, you can only kind of get guesses and kind of ascertain with a probability in a range. So, for example, I can look at a parent's balance sheet. Like Aarti, for example, Aarti Industries and Aarti Pharma. I could look at Aarti Industries balance sheet and guess because they were reporting it that this so much percentage is our pharma business. So 20% of that, or 15 to 20% of their top line was pharma business. So I could kind of make a balance sheet of that business by studying the 10-year history of Aarti Industries, and because they were kind of were good enough to kind of report it together. In cases where you don't have that kind of level of detail of reporting, you still have to kind of so you have something called a scheme of amalgamation document. So by SEBI's regulation, any company that has kind of wants to do demerger spin-off has to submit a very detailed document as to what they're what the reasons and rationale behind it and what the business looks like. And that document contains a lot of details. So in that document, you can still, there's no clear-cut balance sheet, but you can kind of make a guess of how much debt that business might have, or if existing business of the parent company is over leveraged, then it's highly likely that this business might be over leveraged as well. But if it's not over leveraged and if they're kind of spinning off with a clean balance sheet, then that becomes interesting that, okay, if the existing business because of over leverage might be trading in single digit PE, because if it's over leverage, balance sheet is not healthy. But then this spin off business, if it's in a better market or better kind of a business, high margin business with no debt, then that becomes very exciting, that because then you can kind of get something at a cheap price. So the theme is always to get something at a cheap price, and I'm just making this kind of example up. It may or may not happen. So that's kind of thought. So nothing clear cut, but you can through that document and through existing reporting, historical reporting, you can kind of still make a guess.
Okay, sir. So next question is,
Kailashi,
yes.
I'll just request over here, you can just be on the queue because I see only 10
Okay,
minutes left.
okay, no problem. No
And
problem.
Tariq has a
No.
hard stop at 1. So
No problem.
we still have 4 questions. And if there will be time left, I'll again ask you.
Okay,
for the
sure.
question.
No issues. Yeah.
Thank you so much for understanding, Kailashi.
Yeah.
So, Apurva, you can go ahead. I've unmuted you. Apurva?
Yeah,
go
yeah.
ahead.
Hi,
Hi,
Ankit sir. Thanks a lot. Hi, Tariq. A wonderful session here. I think
Thank you.
that's given.
Thank
So,
you.
sir, one thing which stuck with me, I think every session I try to take one lesson. One thing which stuck with me right now is I have termed it as ROTI, which is return on time invested. Can you just, I think we should all focus on increasing our ROTI.
Yeah.
And can you just give us some more examples of how do you look at return on time invested? That is one. And a very small question is that what percentage of normal investing versus spin-offs do you play, or do you only play spin-offs? Can you give us some insights to that?
Sure. So for me, I don't categorize investments. I'll answer your last question first. So I don't categorize investments into categories. Like for me, spin-off, like I said, it's an excuse to buy something at a with a margin of safety. That's the additional benefit that I'm getting because it's a special situation. So for me, the research progress all remains the same. So I have like a rotating list of companies that I want to research. Either it'll come into a screener, or it's all idea generation that kind of goes into that watch list. And if it's a special situation, I'll tag it as that the idea came because of a special situation screener or through an announcement or whatever.
Got it.
And there the process remains the same. Then I'll kind of research it. The entire thing of me researching the promoter, the company, the whatever the process I follow, that remains the same. In the end, I'll do a valuation kind of a judgment to figure out, okay, this should be the fair price for it. This
Got it.
is the scenarios where it's cheap, and then I look at where the triggers are. So if a spin-off is kind of play, let's say in the next 2 months, if it spins off and then I find it that the valuation should be 100 and it's trading at 10 rupees, then all that factors goes into my deciding of a position. And
Got it.
then the rest of it, once it comes into a portfolio, then again it kind of remains the same. It depends on if the triggers are played out, if what the technicals are looking like. So everything remains the same. It's just that you can imagine it like a existing process. The special situation is just kind of coming
So
in through an
it's
idea
in the line
generation.
itself. So basically, the reason
Exactly.
I'm asking this is because you're so fundamentally deep into a company, wanted to understand the kind of number of stocks you usually keep in radar or at least in portfolio. Second is because when you are saying right now that you don't think of spin-off as a differently, you don't keep looking for spin-offs particularly that only I have to invest in spin-offs, but mostly you would have realized that given your last 1 year, maybe out of 10 stocks, would have realized that 6 of them were only spin-offs, or 6 of them would have been something where you found where where special situation was involved, right? So is there a number which you have discovered for yourself as of now, and also number of stocks in your portfolio, given that you're so fundamentally deep into research?
Yeah, sure. So my number of stocks are like 14, 15 stocks in a portfolio, and then which is like 85% of portfolio. And then there's a long tail of rest 15%, which is like tracking positions and just ideas and stuff. The so it like I said, there's not a number like I have to be in like 6 special situations. If a company is available cheap, I'll put even 20-25% of my portfolio in it if there's enough margin of safety. If I can't, if there's no possibility for me, or let's say 5-6% possibility, single hit possibility of me losing 10%, I'll take that risk. And again, like this all, I like to put a caveat that this position sizing and everything has a lot of other variables that goes. You need to look at what your existing portfolio is versus to your income. You need to look at how many dependents you have, how much risk you can take. So all of that goes into it, which is like outside the purview, but I'm still kind of caveating it here because just because something is saved, if I put 25% doesn't mean it's right for you to also put 25%. Your circumstances might be very different. So you might be only able to put 10% or 8% in it. So all of that kind of goes into it, but it's an entire process remains the same. It's just that special situation kind of comes in as an idea generation part. And if there are too many of them happening in the same time, naturally it will become, if it's available, if those are kind of cheap, they will become more. If nothing is happening, then not much will be there.
Thanks, Tariq. So next I'll move to Gautam. Gautam, I've unmuted you. You may ask your question.
Hi, Gautam.
Gautam.
Thank you, Tariq, for the great session. I have been following you from quite some time. You have been a big impact in my portfolio creation.
Thank you.
And my question is like, I'm working for the Indian Army. So is there any, since nowadays the order value is massive. So in this current scenario of high order value, do you find any special situation opportunities are the categories where we can study? Because I can understand the industry and I can know the ground aspects of it. If you can tell certain areas so that I can read more.
Sure. So when you say order value, what do you mean?
Like the number, the orders that is coming from the government, the purchase that the sector is seeing now.
The announcement activity and stuff. Yeah. So I would say if you want to get started, I would say read up on special situation first, like the two guys that I told you, Maurice Schiller and Joel Greenblatt. And then I would also say like spin-offs are probably an area where you can kind of do, but again, that depends on the, like you have to still research the company. And it's not just because of a spin-off, it'll kind of generate return. But that return on time invested, that roti thing, that will help you there, because your like right issues are the number of orders, like you said, is too many. Spin-offs you will find like probably 10. And then within that, if you kind of take that idea and research it, how you will research a company, you will probably find one or two worth investing.
Okay. Thank you.
Yeah. Thank you. Ankit bhai, any other questions?
Sorry, I was muted. I didn't realize. Jatin, Jatin, I have unmuted you. You may ask your question.
Thanks, Ankit bhai. Thanks so much. Thanks, Tariq, for the presentation. I had just one question. Okay, so like this is a kind of a hypothetical question. So for example, if you've invested in a particular special situation, it is playing out fundamentally. You are seeing that like this is a kind of a micro cap company where the triggers are already in motion as per the fundamental perspective. but you cannot see the same triggers in the price of a stock. So how do you like what is the strategy there, and how long like you will give the time to this particular situation to play out?
So you mean that there's a company with fundamentally triggers are playing out, but price wise they are not. Like price is
Yes,
static, it's not moving, and then fundamentally the company is doing well.
yes, yes.
Yeah, then I'll wait for it as long as in fact I'll buy more. So like not with the micro cap and stuff, but let's assume it was a small cap or a mid cap company with enough float, no liquidity issues. I'll double my position or whatever I can do at that point. Because that's the point, right? Like if market doesn't recognize it, so uh, if there's enough margin of safety fundamentally, ultimately even 2-3 years of time, your stock price will always match your earnings power. And if there are no headwinds, there are no things happening fundamentally, things are doing great, uh, stock price will ultimately sometime will move. So it doesn't have that much of a weightage in my kind of analysis or investing.
Oh, thank you, thank you.
Thanks, Jatin. So Tariq, if you have 5 minutes, I can maybe ask Kailash ji to
we can
join
do it.
again.
Yeah, sure.
So Kailash ji, you can join again. I've unmuted you.
Hello.
Yeah, please go ahead.
Hello.
Hi.
Yes, sir. Yeah. So the question, sir, is very simple. If the company is not having any leverage and the promoter's pedigree is really great and they are going for a demerger, so should I say that actually it's a kind of a cinch, it's a kind of a no-brainer. It becomes a no-brainer. Is there any kind of incidents? Is there any kind of incidents that you can recall where things almost, smell, sense like a cinch, but actually it had proved otherwise? So any example like that, just like in case of this Borosil Limited. So is this a simple? Is it's as simple as you get, or something, or another thing could had happened actually in the past also on a disappointment front?
Yes, so I would say nothing in stock market is a no-brainer because especially within special situations, because there's a large regulatory process, like a whole NCLT process that goes through, and that's very unique to India. In US, if somebody wants to demerge, all they need to do is file with SEC that hey, we are demerging, and that's it. Here in India, you have to go get approval of the creditors. You have to go get of the NCLT board and whatnot. So it's a long process. It usually takes about 8 to 10 months. And if something goes wrong in that process, then that original thesis becomes invalid. So a prime example is India Bulls real estate. The problem there was always the previous issues in India Bulls. But the catalyst was that, okay, this embassy was going to come in. It's a bigger company, has better balance sheet, better institutional players tagged to it. If a merger happens, then there was a lot of value in India Bulls. But the antithesis being that there are a lot of cockroaches also in India Bull because of his past, and the one of the NCLT process, the merger may not go through, which is exactly what's playing out today. The merger kind of is on hold. Uh, until the merger kind of goes through, nothing's going to happen there. So things can always go wrong. It's exactly like how and sometimes things goes wrong mostly, which is what we not haven't considered. So it's still all those factors and things can play out. If it's in your hypothetical example, if the company doesn't have leverage, good pedigree of the promoters and stuff, then yes, I'll keep it on radar, but I'll not kind of, if the catalyst is 10 months away, I'll not build a 20% position today. I'll start slowly and I'll wait. If the company spin-off is cheap, then I'll still wait as close to as possible for the catalyst to play out. Yeah.
Thank you so much.
Sir, if I could.
Yeah, go ahead.
Yeah, sir, actually, one thing actually I'm curious, actually, you are into research and you get into everything. So if any business, actually had a great past and great future, but due to the recent past, actually it's in trouble and it's in IBC. So can't we qualify that into a special situation and can't be there, spin-off kind of thrill and returns kind of risk reward, disproportionate risk reward kind of thing. Actually, any thoughts on the IBC companies going into IBC?
Yeah. So again, you don't know when it will get out of IBC. So returns, your return is the denominator is time, right? If you make 100% returns, if you make it in 1 year, it's an amazing CAGR. If you make it in 20 years, it's not really a great CAGR. So so that's the denominator is still time, and here the denominator of time is dependent on what that process takes, of the bankruptcy process takes. So just because if it's in bankruptcy and it will come out someday doesn't make it a great investment. It can still, once it comes out of it, and if you see things happening, then yeah, probably it can be a special situation. But again, it depends on what's the time to execution. And usually in, like, more often and not, time to execution in India is very, very long. So that kind of, because you have everybody has limited capital. If you put it in there, your portfolio returns will automatically suffer.
Thanks a lot. Thanks a lot. Really appreciate it.
Cool. Thank you so much, Kailashji, for the questions. Okay, great. So thank you so much, Tariq, for sharing your wonderful experiments and experience in special situation investing. And thank you so much to the audience. Some of you have asked some really good questions, and it was a well 2 hours spent on a Sunday. We'll put up the recording as soon as maybe tomorrow on our platform, and the edited version of the session will be up on our YouTube channel by the next weekend. So thank you so much, Tariq. Before leaving us, any closing comment?
No, thank you for inviting me. This was great, and I'm glad I could help you. But I'm not a expert in this, so don't consider everything that I said as like a rule or something. I would encourage you to just invest and kind of learn about this. I have always believed that there are multiple skills required to become a successful investor, and I believe this is one of the worthwhile ones to learn.
Thank you so much, Tariq. And thank you so much, everyone. Have a nice Sunday.
Thank
Bye.
you. Have a great weekend. Bye.